Good morning. This is Bloomberg Daybreak Europe. Happy Thursday, everyone. I'm Tom McKenzie in London. These are the stories that set your agenda. Treasury yields hit a one-month low as a gauge of US services enters contraction, fueling bets the Fed will reduce rates at least twice this year. Trump's travel ban is back. This time, the president bars people from 12 countries from entering the US. And he warns Vladimir Putin has told him retaliation is coming for Ukraine's recent drone strikes. Plus, how low will Lagarde go, with ECB widely expected to cut rates for an 8th time today? Investors focus on the path ahead. With global stocks then at a record high, yes, a record high on one of the gauges of global stocks. European and US futures now looking for direction. Maybe it's non-farm payrolls that come out on Friday. European futures currently flat after 3 straight days of gains for both European and US stocks. Here in the UK, FTSE 100 futures just pointing a little lower by about 0.1%. Recent days have seen some strength for UK equities. S&P futures stateside then, after modest gains yesterday, also range-bound. NASDAQ 100 futures pointing lower by 0.1%. Let's flip the board and have a look cross-asset. We do, of course, have that ECB decision later today, almost fully expected to cut again by 25 basis points to 2% for the ECB. The direction of travel from here, though, is the question, of course, and any updates in terms of the guidance and the framework from Christine Lagarde later today. We have Lizzie Burden on the ground for us for that story. 4.35 right now on the 10-year. Services data coming in softer than expected, and hiring as well in terms of the private payrolls coming in weaker, and that led to a rally in bonds and Treasuries stateside, yields lower. Currently 4.35 on the benchmark. Euro dollar at 1.14. Markets now pricing in a little over 2 cuts, by the way, for the Federal Reserve by the end of this year. $64 a barrel on Brent. Gold a little softer by 0.1% on the yellow metal. Let's cross over to Asia right now. A really consequential day once again when it comes to the bond auctions of Japan. Avra Hong standing by in Singapore.
Yeah, Tom, that is the key focus for markets in this part of the world today, that JGB auction for 30 years, which I'll get to and unpack in just a bit. But just looking at the read across the rest of the region, it's mostly risk off ahead of the US payrolls, amid the lack of a phone call between Trump and Xi. Yes, we did see some pickup in Chinese services activity from a private survey, but keep in mind that some of the holiday spending indicators paint a more worrying picture. So yes, Chinese stocks are down, but you can see that there's mostly risk off across the region, including in Japan, where stocks extended losses, as did the Japanese currency, following that poor showing from the JGB 30-year auction. Just one other thing to highlight when it comes to stocks in Japan as well. We are watching out for these signs of how the trade fight involving rare earths seems to have increasingly been involving these automakers, and now it seems like they are getting hit. We had the likes of Suzuki that showed that, they might be halting production of one of their models, the Swift models. The JGB auction, in terms of the bid to cover ratio or the demand gauges, we actually saw it not just lower than a 12-month average, it was also lower since late 2023. So a poor showing all round, but keep in mind this is also following on from pretty weak demand and concerning demand from the 20 and 40-year auction. So maybe traders were already bracing for the worst and might go some way in explaining what we're seeing in the secondary market. For the board, take a look at JGBs. They seem to be staging a relief rally, maybe partially to do with the move in Treasuries overnight as well. But also think about the bigger picture here, because the BOJ meeting comes up in less than 2 weeks from now. Maybe Japanese bond traders are heaving a sigh of relief that they don't have to contend with yet another long-term auction between now and then. So we're also seeing that firmness when it comes to Japanese bond futures. Tom.
OK, yeah, as you say, despite the weaker than expected take-up of those 30-year bonds in terms of the bid-to-cover ratio. Avra Hong in Singapore, thank you very much indeed, with a check, of course, on the Asian markets and that bond auction on the 30-year in Japan as we look ahead to the BOJ in 2 weeks' time. President Trump, meanwhile, announcing a travel ban affecting a dozen countries around the world, reinstating one of the most controversial and defining measures from his first term.
Very simply, we cannot have open migration from any country where we cannot safely and reliably vet and screen those who seek to enter the United States. That is why today I am signing a new executive order placing travel restrictions on countries including Yemen, Somalia, Haiti, Libya, and numerous others.
For more, let's bring in Bloomberg's Charlie Wells joining me around the desk. What details do we have then, Charlie, about this ban? It's been reheated, it's been revived, but with some minor differences from the first term.
So, Tom, ostensibly this is a response to an attack we saw in Boulder, Colorado over the weekend on an event for Israeli hostages. Now, it would apply directly to 12 countries, including Afghanistan, Iran, and Libya. There would also be a partial ban on individuals from countries including the likes of Cuba, of Venezuela, of Laos. And this is immediately going to call to mind that 2017 ban, which within days of coming into office, Trump enacted that initial travel ban from his first administration. If that is a guide for what could happen with this newest ban in Trump 2.0, we could see challenges in the courts, because that's what we saw with the first travel ban. And ultimately, Trump had to pare back a lot of that initial ban. But in a win for him in that first administration in 2018, the Supreme Court upheld basically the bones of the travel ban, which gave Trump a significant kind of hand in how he could manage immigration. And managing immigration is something that he really talked about on the campaign trail. And that is why this attack over the weekend is dangerous for him, because there has been the perception in American voters, whether or not this is accurate, that immigration has led to unsafety throughout the country. And so Trump can't have attacks like these on his watch. So you see him bringing in a measure like this. But if we're getting a through line from Washington in this and from a number of other developments, it's that a lot of these quick wins that Trump promised on the campaign trail aren't materializing. It's now June. He's been in office since January. So he's having to take some measures from that playbook from the first administration.
OK, and you talk about quick wins, and he is also not getting any quick wins when he comes to his conversations with strongmen leaders, whether it's in China, Iran or Russia. He had a conversation with Vladimir Putin, it seems, over the last 12 hours or so. It was a more than 1 hour conversation. What came out of that call between the two presidents?
Tom, not a lot from that call, particularly not a lot moving forward developments on bringing peace to that conflict in Ukraine. And again, this stands in conflict to the message that we heard on the campaign trail, which was effectively that all Trump was going to need to do was to get on the phone with Putin, engage with him in a direct way, in a way that the Biden administration, let's remember, had a very different playbook on, right? They tried to isolate Putin. They implemented a number of these sanctions that have come under criticism from the Trump administration. But what we're seeing here is that just getting on the phone with these strongmen is not enough. And actually, what we saw in this call from yesterday was Trump effectively broadcasting a line that Putin has had about needing to respond to those attacks over the weekend. And those attacks over the weekend from Ukraine were hugely embarrassing for Russia. They were able to pose drone attacks deep within Russian territory as far as Siberia. And you effectively have the president repeating that line about Putin needing to respond to that.
And no sense, at least from the details that we have now, may come out, but no sense yet that President Trump pushed back on that threat from Putin. Meanwhile, domestic politics, and this has broader implications as well, coming to the fore, with Elon Musk really going hard now. I mean, it's part of the story yesterday, but it's really doubled down, Elon Musk, in terms of his determination to kill this spending and tax bill that is being pushed and touted by the president himself.
We're just a few days from Musk departing his temporary role at Doge, and this feels like a very striking kind of 180 from being a part of the Trump administration to then encouraging Americans to kill this bill. And his concern, and a number of other Republicans, is that, you know, there is that $2.4 trillion price tag attached to this legislation. This is showing something of a growing divide within the Republican Party between the kind of deficit hawks on one side and more of these kind of Trump hardliners on another. And what I will just say here is that there really, as far as legislation goes, there's only downside risk, right? We're heading into the summer. We know the Trump administration has wanted this bill to be passed quickly, but if you have Musk, who has an enormous platform, calling on Americans to oppose this, to call their legal representatives to oppose this, that is dangerous for them. Now, one uplift that the administration got was a report from the nonpartisan Congressional Budget Office saying that Trump's tariffs, revenue from Trump's tariffs, would bring in $2.8 trillion. That is more than the cost of this tax bill. So that is something, that is a talking point we're likely to hear them talk about. But time, again, is really not on the president's side here because he does not want to go into the summer with the sorts of opposition that we're seeing from Musk. And this just reminds me of 2009 when in the Obama administration, they were really early. They held that kind of trifecta across the U.S. government on the legislative branch and the executive branch. And they had all of these town halls with citizens talking about their opposition to Obamacare back then. That is not the sort of thing that the Trump administration wants on this big, beautiful bill.
Charlie Wells, thank you very much indeed on the news coming through from the Trump administration. The US House Speaker, by the way, Mike Johnson, will be on surveillance later. Do not miss that conversation from 12:30 London time. Now, Treasuries rallied yesterday as weak US services data adds to bets on 2 Fed cuts this year. Let's bring in Bloomberg's Valerie Teitel for the market reaction. Val, talk us through what the data showed us yesterday in terms of services, private jobs, and how the markets have readjusted to that.
Yeah, well, the biggest market reaction to those 2 weak data prints was a substantial rally in the Treasury market. Those 10-year yields hitting a 1-month low in yesterday's session at 435. We're pretty much holding on to that rally in the Asia session overnight. Over 2 days, 10-year yields have moved lower by 10 basis points. And to what you said about rate cuts, we're now pricing in the September Fed rate cut with a 90% certainty. So that did really cause a Treasury rally across the curve. 2-year yields, 10-year yields, even 30-year yields seeing around a 10 basis points rally. But let's get into that data, especially the ISM services unexpectedly contracting. It's now fallen into contraction for 4 times this year. And this was surprising to some, Tom, because I think there was a conception out there that the ISM services could maybe capture the positivity after that or initial China tariff delay that took place in mid-May. And this survey was done in the week after. So that kind of optimistic view that maybe we'd see an upside reading, really some cold water thrown on that. And we saw those ISM services unexpectedly contracting. We also got the ADP private payroll number. This one had a really big miss by nearly 90K. And the reading was the lowest that we've seen in over 2 years. Now, there is some speculation that this is maybe adding to nervousness heading into the big Friday non-farm payroll print. That one's going to be the big one. Now, it's normally known that ADP and NFP don't normally correlate with each other, but it's definitely adding to the nerves out there. I do want to end on one thing, which is the equity market. The weak data did really little to budge the equity market yesterday. The S&P 500 just barely ended in the green, but we are still eyeing down that bull market from those April lows, up 19.8% from that day.
Yeah, the gains have been modest, but they've been there for the last 3 days, haven't they, in terms of US and European stocks. We'll see how the story unfolds today. Bloomberg's Valerie Teitel, thank you very much indeed on the data front and readjustments maybe to a softening US economy. Here's what else to think about today. 7 a.m. UK time, we're going to get German factory orders. So a touch there in terms of the strength or the weakness, in fact, of course, of the factory sector in Germany as it faces up to a weak domestic picture, but also, of course, the tariff impact. At 1:15 p.m. UK time, we get the ECB rate decision then, almost fully expected to cut again by 25 basis points to 2%. On the main rate. And then we, of course, get Christine Lagarde's press conference as well, which will be scrutinised and we will bring for you live, of course, through programming. And at 1:30 p.m. UK time, we get US initial jobless claims, building out the jobs picture and the labour market for the US as we head up to non-farm payrolls and the big jobs print on Friday. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go. Coming up, the German Chancellor heads to Washington for talks with the US president. We're going to look ahead to their inaugural meeting. Plus, later we will be looking ahead to that ECB rate decision with Sabrina Khanniche from Pictet Asset Management. We'll get her views on the positioning of the ECB and the outlook for the Eurozone economy. That's coming up. This is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
The risk was a downside surprise, the reality an upside surprise.
The shock has affected outcomes.
There's a pretty big cliff from an economic perspective.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
American exceptionalism continues.
This is not what we're going to experience in the upcoming months. Is it going to be Biden data or Trump data?
The May Jobs Report, Friday on Bloomberg.
Welcome back to Bloomberg Daybreak Europe. German Chancellor Friedrich Merz will meet President Trump in the White House later today. Merz has veered between boasting about common ground with Donald Trump to bemoaning the US president's volatility and even at points mocking his bravado. Now they will meet for the first time face to face. I'm joined now by Bloomberg's Michael Nienaber. Michael, what can we expect from this meeting? We've seen previous meetings, of course, in the White House between Ramaphosa, Zelensky that have arguably not got to script. What can we expect when it comes to the meeting between the German Chancellor and his US counterpart?
Yeah, good morning from Berlin. So when Merz meets Trump later today, I think it's fair to say it's so far the biggest foreign policy challenge for the new German Chancellor yet. He's been sworn into office less than a month ago. And so he has never met Trump in person before. So it's actually for Merz the chance to actually build the relationships. If the meeting goes well, he hopes that this can be a starting point to tackle the various tricky topics that are on the agenda. Foremost trade. I mean, there's no other country that's more exposed to Trump's tariffs agenda than Germany, as one of the biggest exporters worldwide, obviously. But also on security, the United States want Europe and Germany in particular to hike defense spending. I mean, here the Chancellor actually has something to present. He can say we're on board with the new goal that NATO is likely to agree later this month by spending up to 5% of GDP. That's a huge increase, and Merz says we can do this. So that might pave the way and prepare the ground also to agree or at least lower the risk of more confrontation on trade and tariffs. But obviously the aides of Merz have briefed him he should prepare for anything. I mean, scenarios range from hearty handshakes like the French President Macron received to public beratings you just mentioned. Also, I mean, we all remember the encounter of the Ukrainian President Zelensky in the Oval Office. The Chancellor is preparing for anything and hoping for the best.
And Michael, this isn't just about Germany's relationship with the US. This is also about the relationship between the EU and the US at a time, of course, of continued negotiations when it comes to trade and tariffs. So there is a broader read-through to the European Union story in terms of its relationship, Brussels and Washington, on the back of this visit, arguably.
Absolutely. I mean, it's a balancing act for Friedrich Merz here, obviously, when it comes to the most difficult topic, trade. He knows well that it's actually not his role to negotiate, and he has made this clear in phone calls with Donald Trump that he doesn't want to, and he can't do any side deals on a bilateral level, although this is the agenda actually of the US administration to try and do different side deals with single EU member states. But Merz and all German officials are pretty clear that they say we're trying to support the European Commission and Ursula von der Leyen in their efforts to agree on an ideally amicable solution in the really tricky and complicated trade conflict. But he will steer clear of trying to send the signal that Germany might depart from the overall strategy of the European Union. But obviously the meeting takes place in this wider context, not only in trade, but also, as I mentioned earlier, on security and higher defense spending. And Merz in the closed-door meeting with Trump will gauge the readiness of Trump to at least keep up some support also for Ukraine in military terms, because there were various signals that the Trump administration doesn't want to keep up the military support, at least not at the level that the Biden administration did in the past. So this means a higher burden, obviously, for the European allies and Germany in particular.
OK, Bloomberg's Michael Nienaber, thank you very much indeed. A closely watched encounter then later today between the German Chancellor and President Trump at the White House. Coming up, it is make or break for Nintendo as it launches its first major new hardware in more than 8 years. We're going to get the lowdown on the Switch 2 as lines are already forming outside shops in Japan. Stay with us. That's next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, it was no ordinary Wednesday for gaming fans in New York. They spent the day waiting for the Nintendo Switch 2 to go on sale at midnight. The console is the first major piece of hardware released by the company in more than 8 years. With most of Nintendo's revenue tied to the console's success, the pressure is on to ensure another blockbuster. Bloomberg Originals takes a closer look.
It's hard to overstate how important the Switch is for Nintendo. Almost all of its revenue comes from this one product, or the exclusive games the company develops for it. Its popularity since 2017 has driven Nintendo's share price to an all-time high. And everything's riding on the Switch 2, keeping that trend going.
The stakes were very high.
Nintendo is at the most successful point in its history.
And here's why. The Nintendo DS, 154 million sold. The follow-up 3DS, 76 million. The Wii, 102 million sold. The follow-up Wii U, oh dear. And the Nintendo Switch, almost the best-selling console of all time, 152 million sold. No pressure then.
Switch 1 created a very high hurdle for the future consoles to surpass.
So Nintendo's breaking new ground with some very subtle shovels.
It's the first console in Nintendo's history that is kind of the same thing, but just a little bit bigger and a little bit better.
That strategy belies decades of corporate lessons learned sometimes the hardest way. But this time, the stakes are just too high for history to repeat itself.
Let's go!
OK, subscribers can watch that documentary right now on the terminal and Bloomberg.com and on the Bloomberg Originals YouTube channel tomorrow. Staying with tech, Alphabet's CEO says the tech giant is developing new products that will drive demand for more engineers. Speaking at the Bloomberg Tech Summit in San Francisco, Sundar Pichai told us more about how AI is changing the way the company works and the impact the company is seeing from the Trump administration.
In this particular moment, with the point of inflection around AI, I do think the next few years are critical from many aspects. So we are committed to engaging. We did that with the first Trump administration. We are committed to doing that. Look, around the world, we comply with laws and regulations in all the countries we operate in. Doesn't mean we agree with every aspect of everything.
Alphabet's Sundar Pichai speaking to Bloomberg's Ellie Chang at the Bloomberg Tech Summit. And there is special coverage from the summit today from 4 p.m. London time, live from San Francisco. Coming up, the ECB widely expected to cut interest rates again this afternoon. But what will they say about the path ahead? We discuss that with Sabrina Khanniche from Pictet Asset Management. That's coming up next. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. Happy Thursday. These are the stories that set your agenda. Treasuries rally as a gauge of US services enters contraction, fueling bets on at least 2 rate cuts this year. We're going to bring you the latest as well from Frankfurt, where the ECB is set to lower its rates for an 8th time. Trump's travel ban is back. This time the president bars people from 12 countries from entering the US. And he warns Vladimir Putin has told him retaliation is coming for Ukraine's recent drone strikes. Plus, Musk on a mission. The Tesla CEO ramps up his attacks on Donald Trump's tax plans, urging lawmakers to kill the bill. Markets right now looking for direction after what was a softer set of data yesterday stateside, whether it's the services data or the private sector payrolls data or indeed the Fed's beige book, all pointing to signs of a cooling US economy. That led to readjustments across the Treasury curve. Today, Treasuries are largely unchanged. The action was yesterday. Yields were lower. Money was moving in to US Treasuries. Today, the focus on the ECB, of course. European stocks, again, looking for that direction. The ECB is expected to cut by 25 basis points to 2% on the baseline rate. FTSE 100 futures currently pointing lower by 0.1%. The context is you've had 3 straight days of modest gains for both European and US stocks. In fact, on a global gauge, you are close to record highs for global equities. S&P futures then also a little softer by 0.1%. Nasdaq 100 futures looking down by 32 points. Let's flip the board and have a look across asset. I mentioned the relative stability in the Treasury market after the rally in bonds yesterday. 436 right now in the benchmark 10-year. Euro dollar at 114. We'll see the adjustments there if they are on the back of the decision from the ECB and, of course, what we hear from Christine Lagarde. Brent trading just below $65 a barrel and gold dropping 0.2%. So, the European Central Bank is set to lower interest rates for an 8th time as President Donald Trump's jolts to global trade lower the outlook for growth and inflation. Lizzie Burden joins us now for a preview from Frankfurt. What are we expecting then today, Lizzie? Could this be the last cut from the ECB, and how are those inflation dynamics shaping up?
It could be the last easy cut, Tom. It would be a huge surprise if the ECB doesn't cut rates by a 1/4 point today, because, of course, the backdrop economically is on Tuesday. We got the latest euro area inflation data, and it dropped to 1.9%, so below the ECB's 2% target, and also dropping at the core and services levels as well. And it comes down to the lower energy prices and the stronger euro against the dollar, all in the aftermath, of course, of President Donald Trump's so-called Liberation Day. But as you suggest, the outlook from here is where it gets cloudier. And that's why we're expecting, alongside the updated inflation and growth forecasts, a range of scenarios to account for all of the uncertainty ahead. Uncertainty in the short term on the tariff front. We just don't know whether the US is going to raise tariffs to 50% on July the 9th. And as you say, whether the EU is going to retaliate. We've got the German Chancellor Friedrich Merz over at the White House today trying to soften the relations, but it could go in the other way. We just don't know whether China is going to dump cheap goods on the euro area as well. And in the meantime, all of that uncertainty just putting a brake on investment and growth in the euro area. The other uncertainty, of course, is in the longer term about infrastructure and defence spending. Is it, going to create the boost to growth that everybody wants, or we need to wait for some more concrete details on that? Of course, we've got the NATO summit later this month, and President Trump pushing for other NATO members to spend 5% of GDP on defence. But until we get concrete details, it is a nightmare for the ECB to forecast that short term versus the long term in terms of the economic impact.
Yeah, and that obviously ties into the debate, doesn't it, amidst those members of the ECB around where to go beyond June. How has that debate evolved, Lizzie?
Well, the thing is, Tom, by July you'll have a lot more information. So, of course, we'll be past that 90-day tariff deadline. We'll also have 2 more inflation reports, 2 more PMI reports, and we'll have the 2025 German budget and the 2026 outline budget as well. So then the question becomes, do they follow up with today's cut in July, or do they wait until September? And most economists think that they will wait until September. But there's a clear argument argument against doing that, it comes down to communications, because the risk for President Christine Lagarde is that the market thinks this isn't a pause, it's actually the end of the rate cuts. And the ECB itself has said that they want to be a beacon of stability. They do not want to be adding surprises into an already volatile market environment. But the argument for waiting, of course, is that if you look at the latest consumer inflation expectations for the next year, they're at 3.1%, and that's the highest since last February. So it may be the case that actually the ECB needs to hike rates further out. So it makes the case for waiting and seeing, and I am sure that in the press conference today, President Lagarde is going to be keeping her cards very, very close to her chest when inevitably she's asked, are you going to follow up in July?
OK, Lizzie Burden at the ECB with that preview. And Lizzie will be on the ground for us, of course, throughout the day with that decision and the press conference from Christine Lagarde. With another view as well and some analysis, let's bring in Sabrina Khanniche now, senior economist at Pictet Asset Management. I feel like Lizzie may have had an eye on your notes, Sabrina, because I'm taking this line out of the notes you sent over to us. We expect this will be the last easy rate cut, echoing what Lizzie Burden has been saying then in her head. For the ECB, the last easy rate cut for the ECB, what is the key factor that makes it more challenging from here?
I think I'm very much in line with what Lizzie just said. So the key downside risk remains trade, and it was highly highlighted by the ECB given the openness of the Eurozone economy. But at the same time, the reason why we expect this to be the last rate cut and the easy rate cut, as mentioned, we had an inflation report which clearly goes in the direction of the ECB. So with the rate cut being more in line with the ECB reaction function in terms of inflation, as said, it declined to 1.9% for the headline, 2.3% for core inflation, services inflation, which was stuck close to 4%, finally eased to 3.2%, which is the lowest level since early 2022, although the momentum remains pretty high. But when we look at inflation drivers, so namely wages, we continue to see this wage normalization, which supported this inflationary trend. So on this front, I think there is no doubt about today. So the ECB will rate cut, but the question is, what about this meeting? So I said, so the key uncertainty is the trade. At the same time, when you look at Eurozone economy growth data, it's more resilient to shocks than it used to be. So growth surprised on the upside in Q1. So it's true that there is some front-loading of exports ahead of the U.S. tariffs, but not only. If we look at the details of national releases, GDP, private demand has continued to be supportive. Another argument being the fact that private sector balance sheet remains pretty healthy. And we have also some upside risk coming from lower energy prices, which is supportive for consumers and company profitability.
Before we get to your views on the growth trajectory into 2026 for the Eurozone, just on inflation, can the ECB do a victory lap now, given what you've just outlined for us on inflation? Have they nailed it?
I think it's clearly going in the right direction. The inflation was mostly driven by services, which itself reflect higher wages. So that's why when you see wages going down, so now it is more consistent with inflation at 2%. Take the Indeed Wage Tracker for the month of April, it declined to 3.3%, so which is more in line with the 2% inflation target. So it is clearly going in the right direction. And again, if we look at the reaction function of the ECB, which is based on the underlying price pressure, the medium-term inflation outlook, the transmission of the monetary policy, so they all suggest that the ECB should cut rate. Now we know that the neutral rate estimated by the ECB is between 1.75% to 2.25%. So we might be slightly in expansionary zone if the ECB cuts to 2%. But overall, we should have reached the neutral level.
And to be clear, you think they cut today and then they hold? Or you think they cut and then they skip July and then they look again at September?
But based on the information we have today, given the fact that the economy is resilient to shocks, we think that this is the last cut. But obviously there is downside risk. As Lizzie mentioned, we are in an uncertain environment because Trump threatened 50% on EU tariffs. So, and we have this postponed until the 9th of July. So what happened from the 9th of July? Obviously, if a negotiation go through and something has been decided between the US and Europe, our baseline scenario go for 10% tariff. In that case, we have less uncertainty and think that we can finally shift from trade tensions to tailwinds from targeted public investment in defense and infrastructure.
We are going to take live pictures right now. Sabrina, bear with me, and thank you for your patience. We have the US Defense Secretary, Pete Hegseth, speaking live at NATO. Let's listen in if we can.
Nope. So glad you're here. And welcome to NATO.
It's great to be here. Thank you.
Why do you think it's important to
Why is so brief, several hours.
OK, Pete Hegseth arriving at NATO's headquarters in The Hague. There is a meeting of NATO defence ministers today, and of course the focus is on that 5% defence target, which ties us to the story in Germany. It ties us to the economic outlook for the Eurozone as well. We'll bring back in Sabrina Khanniche right now. In terms of the defence spend of Europe, when does that start to come through in a material way in terms of the impact on the growth trajectory for the Eurozone?
In terms of defence spending, this is not going to be very fast, especially given that fiscal multiplier tend to be lower. They want to increase defense spending, but if it is about purchasing or increasing defense capabilities, so the fiscal multiplier is lower compared to, let's say, targeted public investment towards infrastructure, where fiscal multiplier tends to be higher. But overall, when we take into account everything, so we have defense spending, but we have also infrastructure spending coming from Germany, which can be conducive to long-term growth, crowding in private investment in Germany, with ripple effect on the Eurozone.
Given that scenario, if we get that defence spend, the infrastructure spend, and if we get that 10% tariff rate, and again, we have to wait to find out what the outcome is come July. If we are in that scenario, are markets underpricing the odds of rate hikes from the ECB in 2026?
Indeed, because when you look currently, the market is mostly focusing on trade tensions, expecting maybe interest rate, the terminal rate being 1.5%. But if indeed we have a positive surprise on the trade front, which is key, actually, so therefore the focus will shift from that to defense spending and the end of the easing cycle, so shifting from the terminal rate by the ECB to when the ECB is going to hike rate in 2026. And this is what we need to wait. We know that Germany came already with the three-pillar fiscal plan, but now there is the second leg with announcement of potentially corporate tax cuts, so supply-side reforms in order to support the economy and the manufacturing sector.
OK. We maybe need to factor in the prospects of rate hikes from the ECB in 2026 as we look to today's cut, expected, of course, 25 basis points. And this could be the last cut for the ECB. That's the view from Sabrina Khanniche, senior economist at Pictet Asset Management. Thank you. Now, the EU economy, meanwhile, Commissioner of the EU economy says there has been progress in those trade talks that Sabrina was saying are so consequential in terms of thinking about the ECB. There has been progress with Washington as negotiators race to prevent higher US levies taking effect on July the 9th. But Valdis Dombrovskis also told us the bloc will not hesitate to impose counter-tariffs if there is no deal.
We do see a negative economic impact from the tariffs already imposed on the EU by US and also on uncertainty which those tariffs are creating, as we know that we are also not yet at the end of the negotiations. So correspondingly, we saw it as one of the factors slowing down European Union economic growth this year, and correspondingly we expect only EU economy to grow by 1.1% this year. So from European Union side, we are willing to find a mutually acceptable solution with United States as regards the tariffs, also to put an end to this uncertainty and to avoid further also global economic fragmentation.
If you guys cannot reach an agreement by this, at least the deadline that the U.S. has put on you for next month, have you prepared a package of retaliatory tariffs against the U.S.?
Well, as you know already, when the steel and aluminium tariffs were introduced by the Trump administration against the EU, we already prepared the first set of countermeasures, counter tariffs, but we also suspended these counter tariffs to give negotiations a chance. But we had reiterated that if we are not able to find mutually acceptable solution, we are ready also to put those counter tariffs in place as regards the first package, which was our response to steel and aluminum tariffs, but also a broader package, which is a response to already further tariffs which had been imposed on the EU. But right now, we are still negotiating. Actually, exactly today, our Trade Commissioner, Maroš Šefčovič, is in negotiations with U.S. Trade Representative, Mr. Greer, and they are making progress.
Commissioner, at the same time, China has announced an agreement to buy Airbus planes, potentially 300 of them. And I wonder how much, while trade negotiations are going on with the U.S., the European Union is moving forward with some sort of discussion with China about tightening ties there.
As regards China, it's worth noting that China is second largest EU trading partner after the US. So obviously for us it's very important to have our transatlantic relations and including trade and investment relations on track, but obviously also relations with China are important.
The EU Economy Commissioner speaking with Bloomberg's Romain Bostic and Lisa Abramovich. Now, the US president has signed an executive order banning foreign students from going to the US to study at Harvard. Donald Trump says the university has no discipline on campus and is to blame for a dramatic rise in crime. An earlier attempt to prevent students enrolling was rebuked in court. Separately, the US Education Department says Columbia University no longer appears to meet accreditation standards, accusing it of violating federal anti-discrimination laws. The Education Secretary says Columbia has acted with what she called, quote, deliberate indifference towards the harassment of Jewish students during a pro-Palestinian protest. Columbia says it is committed to combating anti-Semitism. Coming up, NATO is preparing a summit later this month that aims to ramp up defence budgets in a bid to appease US President Donald Trump. We're going to have the latest from Brussels. That is next. This is Bloomberg. US Defence Secretary Pete Hegseth is urging NATO allies to commit to a defence spending target of 5%. Bloomberg's Andrea Palaciano is in Brussels. Andrea, tell us more about the summit, what to expect from this meeting of defence leaders at NATO.
So the incredible thing about the summit is that it actually looks like they will agree on 5%. And only months ago, when Pete Hegseth first came to Brussels and first delivered President Trump's message, it seemed impossible. Some countries only barely made it to 2%. So it is quite astonishing that they seem to have now agreed, that there seems to be political consensus to move indeed forward to a 5% spending target.
Why is it so important for allies to keep Trump? Is this about keeping Trump happy, or is it about actually realising that Russia continues to pose a threat to Europe?
It is a bit of both, but the 5% number is purely to keep Trump happy. This has been a core Trump demand, and the alliance has complied in a way because they know that they absolutely need Trump in it. They need Trump to be committed and a solid ally because NATO simply cannot function without the U.S. right now in its current setup because the U.S. simply brings more than half of the military capacity of the alliance. And so with a happy Trump, the alliance can continue functioning as it has, more or less. But if the U.S. is not 100% on board, then they simply cannot.
There's some lines suggesting that Zelensky of Ukraine may be involved, at least to some extent, when it comes to the leaders' meeting. Is that an important factor in terms of symbolism, having Zelensky on the ground?
Absolutely. Zelensky has been one of the major figures of all the previous summits. It hasn't always been smooth. He has sometimes expressed frustration at not being invited to join the alliance faster. But this year, his attendance is shaping up to be one of the main things to watch because Zelensky said he's been invited, but the Secretary General, Mark Rutte, won't say it straight to reporters. He seems to be biding for time and waiting to see whether Trump would indeed be happy to have Zelensky at the summit or not. And if he's not happy to have him, then I believe all parties involved will want to avoid a public scene. So it's still unclear who exactly will turn up.
OK, so we'll watch for that part of the story as well, Ukraine's involvement in these meetings. Bloomberg's Andrea Paliciano in Brussels ahead, of course, of that NATO defence ministers' meeting that is taking place right now. We've seen Pete Hegseth arriving, and then, of course, it's the leaders' meeting later in the month. There's plenty more coming up. Stay with us. This is Bloomberg.
Sentiment has changed.
The whole tariff events have impacted mostly, I would say, the growth in the U.S. Market forces, the so-called bond vigilantes, have woken up those to the concern about the growing deficit in the United States.
They are starting to pause or slow down, at least, their allocations to the U.S. Bomb that people are watching is tax policies and potentially a tax war.
Right now, the big focus is on rates and the deficit, obviously, as the current administration is focusing on their big, beautiful bill.
And this is mainly the result of the global trade war, the risk of the tariffs, although not knowing exactly what the impact will be. But Europe certainly appears more attractive now.
And people are seeing Europe as a safe haven at the moment.
OK, Europe is a safe haven, Europe sounding and looking more attractive. Some of the private capital investors there speaking to Kriti Gupta at SuperReturn, of course, about the opportunities in Europe, which leads us on to the picture around inflation. And the work has been done by the ECB. Take your mind back to 2023 when you had overall inflation in the Eurozone at close to 11%. We're now down to 1.9% on a headline level. That is why it's fully expected, almost fully expected, that you will get a 25 basis point cut to 2% from the ECB today. The question is what happens going forward, and that will depend on the trade negotiations, of course, with the US. Sabrina Khanniche of Pictet Asset Management saying we might also want to think about ECB rate hikes in 2026. Again, dependent on those trade dynamics and whether or not the investment comes through on defence and infrastructure. Let's flip the board and have a look at the data overnight from the US. It was the services data that came in below expectations, but also the ADP private payrolls data. It was the weakest print that we've seen, 37,000 in about 2 years' time. You can see that there. So softness in terms of private payrolls, particularly focused on education, business services and health. This all leads up to non-farm payrolls, of course, on Friday. And that seems to be what the markets are waiting for right now, with the estimates looking at 126,000 in terms of jobs added in terms of the jobs print on Friday. That would be down from close to 180,000 the month before. Are we starting now to see cracks in that labour market? All right, we are live from SuperReturn in Berlin throughout the day, speaking to influential voices in private capital. So we'll continue those conversations. The opening trade is up next.